It is becoming increasingly obvious that the smartest investor is the one that plans ahead, and sets up their portfolio according to the tailwinds of the wider economic climate. Dividend stocks, with a high-quality stream of income, offer a range of advantages in our present context, with the most important being its passive nature. One does not need to lose sleep over the frequent fluctuations in the market, attempting to determine how much they have lost. Dividend income ensures consistent gain, regardless of where the stock is trading in the market. Additionally, for those not looking to reinvest their dividends, they stand a great chance to see their disposable income and purchasing power climb amid a potential recession. This is especially true for those who manage to park their funds in stocks during bargain opportunities, where their yields are at attractive highs. In light of this dividend opportunity, that many are increasingly turning to, we present a list of top 5 dividend stocks you could invest in. The stocks discussed in this video are some of the best dividend payers, which can deliver top-notch passive income to their holders. The first stock on our list is the American midstream partnership, Crestwood Equity Partners, which goes by the ticker CEQP. Crestwood Equity is ideal for investors looking for a safe and stable income-generating security. The company ensures protection against market volatility, even amid macroeconomic uncertainty, due to it being an established player within the oil and gas spheres. In fact, Crestwood has built itself up through the long-term, fixed contract model, which essentially shields it from broader disruptions and sensitivities. Up to 80% of its contracts fall within the fixed fee or take-or-pay categories. Similarly, its highly diversified customer base, ranging throughout different industries, and including clients of varying scales, adds an additional layer of safety to Crestwood's operations. In recent years, management has been especially focused on share buybacks and debt reduction. In its most recent quarter, distributable cash flow rose by 50% to $131 million, on a year-on-year basis. Crestwood's forward dividend yield of 9.7% is exceptionally appealing to shareholders, considering the energy sector's median yield of merely 3.37%. Moreover, its cash holding, as per its latest balance sheet of $865 million, demonstrates there is ample access to liquidity, while there is no debt maturity until at least mid-2025. CEQP is a dividend-paying stock that screams safety and stability. It is ideal for the conservative investor looking for a secure stream of sustainable income. The second stock on our list is the closed-ended healthcare fund, Tekla Healthcare Opportunities Fund, which trades in the New York Stock Exchange by the ticker THQ. Tekla Healthcare is a great way for investors to build up a defensive portfolio, with exposure to the inflation-resistant sector of healthcare. Given the inelastic demand for healthcare, it's ideal for those seeking a stable and sustainable dividend income stream. Tekla Healthcare has a portfolio which exclusively consists of giant US-based health players, that include United Health Group, Johnson & Johnson, Abbott Labs, Pfizer, and many more. Similarly, a significant portion of its investments reflect corporate bond holdings and other fixed income securities. The best thing about THQ is that its income is fully tax-advantaged, with 36% of its gains in the last 3 years attributable solely to capital gains. Additionally, it presently pays out its shareholders over 11 cents each month, which works up to an annualized dividend yield of 6.9%. Right now is a great time for investors to enter into a long position, especially when considering that its $20 price reflects a stellar discount on net asset value. As uncertainty about inflation and a potential recession becomes more relevant in the upcoming weeks and months, stocks like THQ may get rushed by those seeking safety in their cash flow. This therefore, is not an opportunity to miss out on. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving, or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. For number 3 on our list, we turn to one of the most iconic players in the investment playing field, the Coca-Cola Company, which trades by the ticker KO. With its market cap of almost $300 billion, and its domineering position within the beverages market, Coca-Cola stands tall as one of the best defensive players in the consumer staples industry. This makes it a great pick that outperforms the top players of the market, in the toughest of macroeconomic climates. In fact, in the bear market of 2022, when the S&P 500 dipped by 20%, Coca-Cola stock actually appreciated by almost 10%. Moreover, despite its large size, the company continues to show both top and bottom line double-digit growth, as reflected in its third quarter results from 2022. The CEO, James Quincey, has been working to restructure the company to a more lean approach, without stretching its product line thin. As a result, Coca-Cola will be refocusing on its more traditional beverages but experimenting with different sized packaging, cans, bottles and overall value packs. This is being initiated with the upcoming recession in mind, in order to stand well prepared against falling purchasing power among the customer base. With this proactive approach, KO is a great stock to park one's funds in. Its dividend yield at 2.7% is relatively modest, but extremely safe against the oncoming global shockwaves anticipated. Above all, with a whopping 60 years of consecutive dividend growth, Coca-Cola is not a dividend aristocrat, but a dividend king. By every metric, this stock is a screaming buy. Next up we take a look at the robust communications equipment company, Motorola Solutions, which trades under the ticker MSI. The company is a global leader in terms of the supply of mission-critical communications and analytics-related product packages and services. It is especially well known for being the largest supplier of land mobile radio equipment, and thus works with government agencies of a local, state and even federal level. This makes its business model largely resistant to inflation and recessions. The management has been following a stellar strategy of using its strong free cash flow to make small, yet highly strategic acquisitions of critical players to expand its integrated communications ecosystem. Through this approach, Motorola has made great strides in the segments of command center software, LMR communications, as well as video security and access control. Altogether, MSI has placed itself in front of a $50 billion total addressable market, owing to its rocketing business growth. This is a major reason why MSI has so tremendously outperformed the S&P 500 for the last 5 years, with its 190% price return in comparison to the 40% growth shown by the wider market. Similarly, although MSI's dividend only yields a modest 1.23%, it has been growing its payouts by double digits since 2012, without fail. This constantly rising dividend income is not only highly appealing in light of wider macro uncertainties, but is also incredibly sustainable, with Motorola's sound and strategic prowess. MSI is thus a clear winner. The final stock on our list, and far from being the least, is the multifamily lending REIT, Arbor Realty Trust, which holds the ticker ABR. Arbor Realty is the prime example of a REIT that has proactively strategized and played its cards well, such that it is performing tremendously in an economic environment where even top players have been brought to their knees. Given that 97% of Arbor Realty's debt is structured on a floating rate, it has seen its income interest jump by 42% year-on-year, to almost $100 million. Furthermore, due to ABR's rock-solid business model, even in the harsh macro climate of 2022, the company saw its total portfolio jump from $14.6 to $15 billion, whereas its weighted average yield grew from 5.2% to 6.6% within a single year. Despite its stellar performance, however, ABR has not been immune against the bearish sentiment of the wider market, given it being a relatively smaller REIT, with a market capitalization of below $3 billion. For this reason, its stock has shed 26% of its price in the last 12 months, and is trading close to its 52-week low. This not only puts ABR at an incredible bargain, but also puts its dividend yield at a whopping 12%, which is far higher than even top high-yield ETFs. Moreover, it has been upping its payout by a compound annual growth rate of 10% since 2019. ABR is a no-brainer for those seeking high-yield dividends while backed by a strong business. Its floating interest rate exposure aspect is a great way to survive the aggressive US Fed interest atmosphere. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for maximum and sustainable dividends. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.